Good morning, everybody, and welcome to the Daily Energy Markets podcast. It is Wednesday, June 14th at 10:30 a.m. in the UAE, at least. Let's kick off with Mark Ostwald, Chief Economist and Global Strategist at ADM Investor Services International. Mark, I was expecting that given the recent moves by OPEC Plus, all about cutting in the last few meetings, and again next month Saudi Arabia, although unilaterally, nonetheless OPEC's most important member will cut a further million barrels a day for the month of July. And yet OPEC came out yesterday with their report saying actually they're holding on to their demand growth forecast for 2023 at above 2 million barrels a day. How do these two things coexist?
Well, I think, as we all know, of the three oil market reports that we get every month, the OPEC one seems to be always the one which seems to talk their own book. So to a certain extent, I think the predictions for demand growth that they're seeing at the moment really is just basically trying to talk to their own book and saying, well, look, you think that we've got a demand deficit. We think actually it's not going to be a demand deficit and there's going to be less supply than you think. I think it's largely self-serving. It'll be interesting to see how that contrasts with what the IEA says today.
Dr. Iman Nasseri, Managing Director, Middle East, FGE Dubai. If Mark Ostwald has doubts about OPEC numbers on the supply side, the markets in general seem to have doubts on the biggest customer side. Can you trust China's numbers? Your thoughts on this disconnect?
Well, as Mark said, the balance consists of supply and demand, and while they could keep their demand on their view on demand, how much, especially the non-OPEC Plus members, they think will contribute to supply and the growth, including US, could justify, because at the end of the day, they eventually want to see, or everyone's balance wants to see the stocks remain the same or not draw too much. Now on China, as you mentioned, they have revised up their forecast for a bit on China demand, but we at FGE still think that that's still a bit too bearish, and China's demand could be higher despite all the pessimism and basically.
And where do you look for that little bit of extra optimism? And ultimately, the data coming out of China, where are you triangulating your insights to get a bit more of a bullish outlook for China demand in the second half?
Yeah, we have, if I want to put a number on it, we have 900 kbd of total year-on-year growth in Chinese demand this year, where that compares with 800 something that I think their latest forecast has put China's demand growth this year. That, however, I have to say that is heavily geared toward transport fuels, which is jet fuel and gasoline, and perhaps stronger than some others anticipate, and that comes based on all things considered, mobility indexes, expectation on travels and tourism, and seeing how basically the statistics come out in terms of local and international flights. On the other hand, on the industrial front, which comprise of the other basically gas oil, fuel oil, and to some extent naphtha demand for petchem, we're still as bearish as most others are, and the PMIs, of course, are suggesting that it is still far from recovery mode. So I think we're seeing a bit more. We're a bit more optimistic on air transport as well as road transport fuel demand this year in China.
Dr. Charles Elinas, CEO, Cyprus Natural Hydrocarbons Company and Senior Fellow at the Global Energy Center at the Atlantic Council. Good morning, Dr. Charles.
Morning.
It would seem that oil prices, Brent at least, while it was dropping earlier in the week towards that dreaded $70 on Brent. It has climbed back on some optimistic sense that the US will pause interest rate hikes for the first time, and with that give the economy a chance to perhaps grow, expand. Your thoughts on that intersection point, at the plateau, the end of the rate tightening cycle in the OECD, the G7 country, at least in the European and the US, will give the markets a lift?
Undoubtedly it will. I think the situation is also clearer from the way stocks are going in the United States. For the first time, the Dow Jones has gone highest than ever. It seems to be increasing, anticipating better times ahead. So I think that is a clear indication that there is an expectation of that the United States will pull through. The same cannot be said about Europe, though. In Europe, we have problems. We have serious problems. German economy is in trouble. There are continuous dire warnings coming out of Germany. Germany now is warning that industrial output will go further down, and especially if Ukraine next year doesn't renew the gas supply contract with Russia. The UK economy is in a mess. France doesn't know where it's going. So Europe is in difficulties. It's not clear which direction Europe will go. If anything happens to pull OECD through is through the United States. And I think there, data show that the optimism may be well-founded. Can I just also...
just on that point, sorry, go ahead.
I want to add one point about China. China has realized that growth is not where it should be, and they have cut the interest rate for the first time in 2 years. And this readiness to cut their interest rate shows that China is determined to give a push to growth. And I think they will succeed. I think we'll see better results during the second half of the year.
I was going to pick you up on your comment there regarding Europe and its sort of negative growth outlook. Clearly, the big economies are on a low trajectory of growth, but this sort of long-warned recession just isn't coming. The job numbers last week in the US were like 100,000 above expectations. I mean, this is an economy that continues even in Europe to add jobs.
I don't think Europe, or especially the United States, will not go into recession. I don't think Europe is going to go into recession, but growth is stuttering. The big economies are facing problems, and Germany's problems are yet to come. We haven't seen everything in Germany yet. The sentiment of industry in Germany is negative. It's expecting things to get substantially worse by next year. So I don't hold much hope that Europe growth is going to return in significant numbers.
Mark, I mean, we've all been a victim. I was listening to a commentary this morning earlier on the FT about that this rally in the equity markets is the most hated rally by Wall Street and the City of London, by the bankers, if you like, because they've all been waiting for this recession and they haven't jumped in. They've missed the boat, and it keeps on going further away from them and all of us because this so-called recession is not arriving. Should we all just give up and forget about this negative narrative? The glass half full, right? You could either look at the job numbers and go, yeah, that's a bionic economy and upward, or you could look at the credit access to credit tightening and you're like interest rates and go, no, that there's a negative horizon here. Your thoughts on that, and sort of just giving up on the recession narrative and joining the sort of irrational exuberance, as Alan Greenspan once said?
I'm not sure really it's irrational exuberance. I think really what it tells us, and you've got sort of like almost polar opposites in terms of what's happening with the oil market and what's happening with the equity market. It's well worth noting the S&P 500 last month was up, I think, 0.5%, But if you take out all the AI stocks, the Nvidias, the Microsofts, Google, etc., it was actually down 2.5%. So, when we're looking at it, we need to sort of dig down into what is in that so-called optimism being shown by the equity market. As far as the narrative around recession, I think my problem with this again is one about binary interpretations. We keep on wanting to go, oh my goodness, we've got to, everything's going to fall out of bed. As much as I don't want to offend anyone in India, I can recall doing a couple of interviews with NDTV a few years back. And literally, if the market was up 0.1%, it's going up forever. And if it was down 0.1%, it was basically doom and gloom. And I think that's where our problem is, that we can't accept the fact that we've got basically sluggish growth globally. That's basically the key point at the current point in time. That's not incorrect.
The equity markets haven't got that memo, because clearly, while they've always forward pricing, it's not. I mean, the equity markets are forward pricing 6 months, whatever the next earnings cycle, but they're not 2 years ahead. I mean, what is the energy markets not seeing that the equity markets are?
Well, what the energy market's not seeing, and you can see it if you look at it across the broad spectrum of commodities, is the interest from investors. Basically, we're 30 to 40% down across the board in terms of the speculative investor interest in the commodity markets, and above all, that's particularly bad in terms of energy markets. There's simply, there's been huge disappointment. People were long and they were wrong. And basically now we've turned that around. The equity markets, by contrast, and I think the most important thing to remember here, this is really still about the excess amount of liquidity from central banks. We've basically flattened out, the quantitative tightening. Actually, if you look at the Federal Reserve's balance sheet, there hasn't been any quantitative tightening. There's been a few blips up and down since basically the start of the banking crisis, or the regional bank crisis in the States. So it is about that excess liquidity and people looking for places to go, basically park their money. And most people are taking on board the narrative about the global recession. So they're not really jumping in, particularly because of what's been going on with China. They're not jumping into commodity markets, but they still see a lot of potential, particularly in the tech sector, which I can understand, though I still feel it's a little bit 2000-ish.
Yeah, one must always remember that the Fed balance sheet is now at closer to $9 trillion. When this 10-year quantitative easing train started, it was at 800 billion. So a multiple tenfold of liquidity sloshing around looking for a return. And clearly the equity markets has been its home of preference. Dr. Imam, I wanted to get your views. We seem to have a return to some volatility in the gas markets in the last few days. Is the fight for LNG supply over? Everybody had thought they'd sort of packed up their beach clothes and put the towel out and were ready to get a sunbathe. And now it looks like LNG is back on the battle lines, and Europe might be fighting another energy crisis on the horizon, with a jump this week of 20% in the TTF.
Yeah, well, that jump is based on a lower base. I think TTF somehow managed to ease far below expected ceiling in a post-Russia-Ukraine situation, and that jump is more of a correction to what I think was a bit of too relaxed kind of pricing for TTF.
The TTF had fallen 90% from its peak last summer. Last summer, it hit a high of $340 per megawatt hour, and as you say, this last week it jumped 20% up to $36. So yes, it's perhaps in relative terms, but
yeah,
nonetheless,
relative terms, yes.
The outlook for the period ahead and the competition for LNG cargoes, do you expect that to return?
Yes, I do, and that's basically simple logic. LNG is in many ways far easier market than oil, because at least we know the supply. There's no magic supply of LNG emerging all of a sudden, because we have all the plants and capacities, and the only parameter variable there is demand. And of course, then you have the contracted demand, which is all the long terms people who have locked in, and then fight for the spot barrels, which will push the spot prices and short-term contracts up. But when we look at the balances, yes, we do expect basically return of that fight for LNG this winter as well as next year, and relief could only emerge perhaps in 2025, 2026. And until then, this will continue to be obviously seasonal trend in prices as well as demand for LNG, which has helped the prices to come down. We should see basically rebuilding stocks, inventories in Europe also supporting prices going forward, but we will have another kind of high-priced winter coming this year for sure.
Dr. Charles, we just had Shell announce its dividends, a bumper 15% dividend it's going to be giving back to shareholders as it announces its pivot away from the transition and back to its history, its historic roots in bolstering oil and gas production. Do you expect, obviously the European majors have making this move, BP has done the same. What's your outlook for that in terms of a trend and its impact for future supplies?
I think all European majors, BP, Shell, Total, are shifting back into their traditional business. They're not abandoning their commitment to climate change and clean energy. They are sticking to the targets they gave before, but they're shifting emphasis back to oil and gas, having seen ExxonMobil and Chevron perform so well last year, and having seen the global shift towards energy security, which implies that at least for the next decade, energy security will be high on the list. Oil and gas will be an important part of that. So all of the European majors are recognizing that and shifting.
And are the political leaders tolerate? Is the political winds of going to facilitate that? Are they going to hold them to account for, because it's typically still in the European Commission and Ursula von der Leyen are still advocating a strong energy transition?
Absolutely. European Union is not shifting direction. In fact, if anything, it's pushing harder. But the Council of Leaders of the European Council of Leaders is rethinking the whole thing. They are actually putting a bit of a brake on the shift of the European Commission towards more and more clean energy. And some of the political developments in the countries are also pointing in the same direction. In the UK, as you know, Sunak has come clearly out and said that oil and gas has a long way to go. It's going to be part of our future for a long time to come. Here in the Netherlands, the votes cast for the Farmers' Party are an indication of a change of direction. I think that is happening throughout Europe. There is a sort of a brake being put towards what the European Commission is doing. And the European Commission is coming to a head right now. As we go into next year, the European Commission will be concentrating on the elections for the next Commission. So I'm not so sure we're going to be seeing this drive towards increasing climate change commitments anymore. I think a break will put on that. And Macron said that let's stop and recoup and see how far we have gone so far before we go any further. So I think that sentiment is going to prevail.
Let's go to the survey question this morning, just touching on some of the points we discussed earlier. Oil prices will eventually follow equities higher to irrational exuberance land as Fed ends tightening cycle. Oil prices will eventually follow equities higher to irrational exuberance land as Fed ends tightening cycle. Do you agree with that statement? Do you disagree? Will who will relent? Will equities relent first, or will oil prices join the party and be damned? Mark, looking to the decision, obviously on the rate hike, I think it's pretty locked in now that the Fed will, as they say, pause today, or stick, or whatever the jargon might be. I referenced a previous central bank's jargon, irrational exuberance, but we're in the zone of ending tightening cycle, it would appear, on the rate hike side. Is that the worst of it now done? I mean, from the pain point of view, or is the sort of lagging effect of these rate hikes still to kick us all in the shins, do you think? And that second half of the year narrative that this 2023 has been built on just won't arrive?
I wouldn't disagree with the idea that we're pretty much near the peak of the cycle in rates. We still have plenty of scope for nasty surprises, so to speak. We've seen it in Canada. Having gone from they're going to keep rates unchanged and then cut next year, we're now looking for yet another rate hike to 5%. Australia, similar sort of story. With the Fed, I would definitely go with the idea that they'll go in July. With the Bank of England, the Bank of England is probably the one exception in all of this. We've now got 5.75% rates locked in almost in markets, and that's from where we are now, and that's a long, long way. I think the problematic is that rate hikes basically impact with a very big lag, and in a world which has got a lot of fixed term loans for businesses, for consumers, you don't actually start to see the impact until quite a way away. So it's in the second half of the year, and we're already seeing it in some countries where, particularly with mortgages, there's been a huge hit. And I think particularly in the UK, that it's going to hit hard there. So the credit tightening part is the story for the second half of the year. You're already seeing delinquency rates rising, albeit from very low levels, one would have to stress, but they are near doubling. And that's really where the problem's going to come, that financing conditions are going to get a lot tougher, and there are a lot more people who will need to refinance in the second half of the year, and they're not going to like the rates that they're going to be facing. And that is probably the biggest headwind to most of the major economies.
Dr. Aman, we're still all kind of digesting the outcome of the recent OPEC Plus meeting from 2 weeks ago. I'm wondering, where's FGE's analysis on that now? Was it a success? Did Saudi get or not get what it wanted? And your outlook for this unilateral Saudi cut to sustain beyond July? Your general thoughts coming out of this OPEC meeting 2 weeks later?
It was certainly a meeting with several, let's say, messages in these decisions they made and announced, and basically the amount that it took and everything sent several signals, couple related to next year and how they want to basically present next year's balances and the direction that they want the oil market to go, or they expect, but also this year. Now, with this year, obviously the main and only decision that they took was the unilateral decision by Saudi to cut 1 million barrels per day. The rest remained pretty much the same in terms of supply. That 1 million barrels per day, I think, was Saudi's own decision to direct the market, and also to perhaps send the signals that were reiterated many times by Prince Abdulaziz in terms of he doesn't want the market to be so predictable or kind of easily impacted by the speculators. Hence, it was a surprise, and the fact that he said it's possible to roll over is another uncertainty that he has added. In terms of our analysis, we think we will continue to see significant draws for the next few months, at least through third quarter, of 1 to 2 million barrels per day. Market will be short and the inventories will continue to draw. In our balances, however, we have assumed that Saudis will continue and roll over that 1 million barrels per day cut into August and September. But by then, we expect the prices have inched up towards $90 or above, and that will basically could trigger them phasing out over September, October time, their voluntary unilateral cut. But in terms of the overall extension of the agreement, 1.6, 1.7 million into next year, our analysis again suggests that the fundamentals based on our S&D will push OPEC towards phasing out the cuts sometimes end of first quarter or into second quarter next year. Otherwise, we'll have really high prices.
What about in all of this? There is the need to accommodate the return of Iran and in time Venezuela, because it does look clearly that the Americans are no longer going to be policing those sanctions in a robust fashion, and Iran is now would appear exporting as much as it can, even underpricing Russian barrels into China. How big a factor is Iran in all of this and that supply coming to the market?
I think it is a big factor, and many clients ask me, and what I said was that Iran is actually currently and almost a year into an interim deal, unwritten and unofficial. They are exporting over 1 million barrels per day of crude, and you add to that 200 kbd of condensates and about 900 kbd to 1 million barrels of products. They're way over 2 million barrels per day of supply they're putting into the market, which is not necessarily on everyone's books, especially with OPEC. If they take the secondary sources of 2.6 million barrels per day production, versus our assessment of 3.05 to 3.1 million barrels per day, that's already 400 kbd, and also all the cargoes, product cargoes that they place into the market, which are hidden from many balance sheets. So I think that was taken into account, together with the possibility of the return. Obviously, we had this rumor of a deal which pulled the prices down by $4. That shows basically how the market is ready to price in that kind of uncertainty, because that wasn't even a well kind of explained deal, but wasn't ready to put on a more certain 1 million barrel per day cut upward and into the price when Saudis announced that. If Iran gets a deal of that kind, interim, or in my full analysis, if it's even a full deal or lifting fully sanctions, Iran doesn't have much to offer, and many perhaps overestimated how much Iran can bring back to the market. I think what's going to happen is that their unwritten interim deal that they're currently doing, and the barrels are coming to the market. The US is having a
there's certainly that floating storage that they've had that's generally been known over the last year or so that has been waiting to try and get to market.
That we think is already drawn significantly with very little.
Let's go to Dr. Charles for the last word and the survey result. Dr. Charles, I wanted to get your views. So agree that the oil prices will eventually follow equities higher, but still a kind of a mixed bag there. We'll post that on the social channels. One of our regular commentators, Dr. Charles from Azerbaijan, was dancing a jig last week that Mr. Erdogan was re-elected. I would imagine in Nicosia that jig wasn't so jumpy. What is your thoughts now, 2 weeks later after, or is it a week after President Erdogan's re-election, and now in a sort of commanding political position? Where does the region go from here in terms of the East Med?
Well, we can see some positive signals. Even in Nicosia, which you said might not like it, actually they prefer Erdogan than the opposition, because at least they know which direction he's going. He was in Cyprus this week and made it clear that he sees the future of Cyprus as two separate entities, two separate countries. But he also made some positive changes. He appointed the central bank, a lady with traditional economics background, and it signals that Erdogan's Erdo-economics, as it was known, will probably disappear, and Turkey will follow a more traditional route to economics. He is making positive signals to Europe for cooperation and looking for help from Europe. With Egypt, there was an announcement by the foreign ministers of the two countries just recently saying that they see normalization of relations. So, the initial signals are Erdogan is looking towards restoring the situation in Turkey. The economy is in dire trouble. There was a recognition that the lira was overvalued, so they allowed it to float and reach a level that is more acceptable, more in line with global markets. There is a recognition, I think, that Turkey is going to be trying to move back into normality, back into the global markets. However, he is not necessarily going to change completely. I mean, we see resistance towards Sweden joining NATO that continues, and he's trying to extract more out of Sweden. So I think the future with Erdogan will be a bit more cooperative, but it will be transactional. He'll continue demanding returns for any concessions he makes, and he will continue being unpredictable. I don't think he's going to change that tune. And remember that this is the 100th year of the declaration of the Turkish Republic, and Erdogan wants to leave a legacy behind, a legacy similar to Atatürk. He sees himself as a new Atatürk. So all of these things indicate that perhaps over the next 4 years, we will be seeing some hopefully positive changes.
Well, certainly you would have to say, if nothing else, that Turkey sits there as a sleeping economic giant, and after the turbulence of the election period and the year run into it with the tragic earthquake, perhaps just getting out of the way of natural economic order will allow for the country and its people to have some relief. And certainly the equity markets in Turkey would indicate that there is a great level of optimism, at least there, that the future is positive. Let's wrap it up. We close out with oil prices trading a little bit up this morning in Asian trade at 74.68 on Brent, stepping back from those very scary lows, at least from an oil producer point of view, where they touched 71.84 at the low of the last week, just earlier this week on Monday, and now are sort of gaining back to that, what appears to be the Goldilocks mid-70s, that $75 number, where the market on average has kind of sat for the last number of months with these moments of change, but that seems to be the Goldilocks spot. Thanks, everybody. Really appreciate it. Great to have your insights. Mark Oswald, as always, from London, Dr. Aman Nasseri from Dubai, and Dr. Charles Elinas from Holland. Thank you very much for your thoughts and insights today. All the best.
Thank you. Bye.
Thank you.
Bye.